In a world increasingly dominated by centralized institutions, a quiet revolution is underway, one that promises to reshape the very foundations of our financial system. It's a movement born from code, powered by community, and driven by a single, powerful idea: decentralization. This is the story of decentralized finance, or DeFi, and how it's unlocking a universe of opportunities once reserved for the privileged few. For generations, the global financial system has operated behind closed doors, a labyrinth of intermediaries, gatekeepers, and opaque processes. Banks, brokerage firms, and insurance companies have dictated the terms, controlled the flow of capital, and profited from their central position. But what if we could build a new system? A system that is open, transparent, and accessible to anyone with an internet connection. This isn't a far-off dream. It's the reality being built today on the blockchain. DeFi is more than just a new set of financial tools. It's a fundamental paradigm shift. It takes the core functions of traditional finance lending, borrowing, trading, and earning interest, and rebuilds them on decentralized networks, primarily Ethereum, by replacing corporate intermediaries with smart contracts, which are self-executing agreements written in code. DeFi creates a system that is trustless, permissionless, and radically transparent. Every transaction is a public record, every rule is encoded for all to see, and every user is in complete control of their own assets. This is not just an incremental improvement. It is a complete reimagining of what finance can be, opening a door to a more equitable and efficient future for all. At the heart of this financial renaissance lies one of its most powerful and disruptive innovations: decentralized lending and borrowing. Imagine walking into a bank for a loan. You're met with paperwork, credit checks, and a lengthy approval process, all mediated by a loan officer whose decision is final. Now imagine a world where the bank is an algorithm. The rules are transparent, and approval is instantaneous. This is the reality of DeFi lending protocols. These platforms operating as autonomous money markets allow users from anywhere in the world to lend their cryptocurrency and earn interest or to borrow against their existing crypto assets without ever filling out a form or speaking to an agent. The process is elegant in its simplicity. Lenders deposit their crypto into a liquidity pool, a large collection of assets managed by a smart contract. In return for providing this liquidity, they begin earning a variable yield paid out by borrowers. Borrowers, in turn, can access these funds by depositing their own crypto as collateral. The entire system is over-collateralized, meaning borrowers must lock up assets of greater value than the loan they are taking out. This mechanism, enforced by code, virtually eliminates counterparty risk, protecting lenders and ensuring the stability of the protocol. The interest rates are not set by a central committee in a boardroom. They are determined dynamically by supply and demand within the pool. When demand to borrow is high, rates rise, incentivizing more lending. When demand falls, rates decrease. This creates a highly efficient, self-regulating market that operates 24/7, unconstrained by geography or traditional banking hours. For savers, this offers an opportunity to earn yields that often dwarf those found in traditional savings accounts. For borrowers, it provides immediate access to liquidity without selling their assets, opening up new strategies for investment and financial management. It's a system where capital flows freely, driven by market forces, not institutional bias, bringing the power of global credit markets directly into the hands of the individual. Beyond the world of credit, DeFi is also revolutionizing the very act of trading assets through the rise of decentralized exchanges, or DEXs. For decades, the landscape of financial trading has been dominated by centralized exchanges like the New York Stock Exchange or modern crypto platforms like Coinbase and Binance. These entities act as trusted third parties, matching buyers and sellers, holding customer funds, and maintaining the order book. While they provide a crucial service, this centralization comes with inherent risks. They are single points of failure, vulnerable to hacks, server outages, and regulatory pressure. They hold custody of user funds, meaning if the exchange goes down, your assets could be lost. Furthermore, they have the ultimate power to halt trading, delist assets, or censor transactions, placing immense control in the hands of a single corporation. Decentralized exchanges offer a radical alternative. Built on blockchain technology, DEXs facilitate peer-to-peer trading directly from users' own wallets. There is no central intermediary, no order book controlled by a company, and most importantly, you never lose custody of your funds until the moment a trade is executed. The innovation that made this possible is the automated market maker, or AMM. Instead of matching individual buy and sell orders, AMMs use liquidity pools, similar to those in lending protocols. Users, known as liquidity providers, deposit a pair of assets into a pool, such as E, T, and USDC. The price of the assets in the pool is then determined by a mathematical formula based on the ratio between them. Traders can then swap one asset for the other directly with the pool. This model ensures there is always liquidity available for trading and removes the need for a traditional order book. The benefits are profound. This structure dramatically increases transparency, as all trades and pool compositions are recorded on the public blockchain. It enhances security by eliminating the central honeypot of user funds that attracts hackers. Perhaps most importantly, it creates a censorship-resistant trading environment. As long as there is a liquidity pool for an asset, anyone can trade it permissionlessly. This opens up global markets to anyone, anywhere, fostering a more resilient and equitable system for exchanging value. As the DeFi ecosystem matures, it has given rise to even more sophisticated ways for users to put their capital to work, namely through staking and yield farming. These concepts represent the next evolution of earning passive income in the digital asset space. Moving beyond simple interests to more active and potentially more lucrative strategies, staking is a mechanism core to many proof-of-stake blockchains, which are an energy-efficient alternative to Bitcoin's proof-of-work model. In these systems, instead of miners solving complex puzzles, network participants stake or lock up their cryptocurrency to help validate transactions and secure the network. In return for performing this vital service and putting their capital at risk, stakers are rewarded with newly issued tokens from the network. It's akin to earning interest, but your deposit is actively contributing to the security and operation of the blockchain itself. This aligns the incentives of token holders with the long-term health of the network, creating a powerful economic feedback loop. Yield farming, on the other hand, is a more complex and dynamic strategy that can be thought of as liquidity mining on steroids. It involves actively moving your crypto assets between different DeFi protocols to chase the highest possible returns. A yield farmer might start by lending their assets on one platform to earn interest, then take the receipt token from that loan and stake it in a liquidity pool on a decentralized exchange to earn trading fees. They might then take the token representing their share of that pool and stake it yet again in another protocol to earn a third layer of rewards. This process, known as composable leverage, allows sophisticated users to stack yields and maximize their profits. While it comes with higher risks due to smart contract vulnerabilities and market volatility, yield farming showcases the incredible interoperability of DeFi. Different protocols can be combined like financial Lego blocks to build complex high-yield strategies. Both staking and yield farming represent a paradigm shift in how individuals can interact with their capital. No longer are they passive savers, but active participants in a dynamic, open financial ecosystem, earning rewards for providing liquidity, securing networks, and driving the growth of this nascent digital economy. The journey into decentralized finance is a journey into the future of money itself. We've seen how it's dismantling the old walls of traditional finance, creating open and autonomous markets for lending and borrowing that operate with unparalleled efficiency and transparency. We've explored how decentralized exchanges are placing the power of global markets directly into the hands of individuals, free from censorship and central points of failure. And we've uncovered the innovative strategies of staking and yield farming, which are transforming passive savers into active participants who are rewarded for contributing to this new digital economy. This is more than a technological curiosity. It's a social and economic movement. It's a system where your access to financial services is determined not by your wealth, your connections, or your geography, but by your access to the internet. The road ahead will not be without its challenges. The space is still nascent, the technology complex, and the risks are real. But the promise is undeniable. DeFi represents a once-in-a-generation opportunity to build a financial system that is more open, more equitable, and more empowering for everyone. The door to this new world of opportunity is not just unlocked, it has been thrown wide open. The question is no longer if this revolution will happen, but how we will choose to be a part of it. The future of finance is not being decided in corporate boardrooms or by government committees. It is being written, line by line, in the code of the decentralized web, by a global community of builders and believers.